Hi, this is Erik Epp. This video is the first in a series of educational videos sponsored by KISS Option Picks. As you can see from the title page, it's called Apple versus Oranges, or Accurate Reporting of Trade Results. I will be sharing with you tips to be aware of when you're looking at trade results of different services. Please take a moment to read this risk disclaimer, as we are required to post it by law. Okay, four main distinctions we want to look at. The first one, that the trades are not hypothetical. The second one is that the trades that were actually went out were actually also filled. We also want to make sure that those trades are documented by the brokers, and naturally, if they were filled, they will be documented by the brokers, and also that all the results include the costs. Okay, here's a reporting basis. You want to look for reporting that is not based on the best possible price or average price, but it's actually based on a worst case scenario. So no matter what happens, the results will never be worse than what is reported on the track record or the results record. And also that all the prices are realistically. Once again, if they're based on a worst case scenario, then the results will have to be realistic. The trading costs are included in a trade are commission costs, which every time you buy or sell either a stock, an option, or any other trading instrument, you have to pay a commission. There are assignment costs, which really relates to options if the option is being assigned or exercised, and we'll talk about it later. And there are also some trades that require margin. The commission costs, based on Option Express, the largest options broker in the US for retail customers. Their commission schedule is based on $1.50 per contract, or minimum $14.95 if it's less than 10 contracts, and to buy or sell stocks it's $9.99 with no minimum or maximum number of shares. The assignment cost in when an option is assigned or exercised and is based on Thinkorswim, the second largest brokers, and is a cost per strike of $15. And it doesn't matter how many contracts at that point are being exercised or assigned. Margin calculations. Some trades will involve margin required by the broker, and therefore there are margin calculations by the brokers of how much margin costs you'll have to pay. Now, if spreads are being used, which is usually goes with options, then most brokers will use margin calculation on one side of a spread if you use more than one spread. And if the width of the spread is not the same, then they will usually use the larger side. Okay, what are you looking for trading results? What you want to look from every trade results: honest, accurate reporting. The results are not compounded, because that could be just manipulated, updated when suggested or changed, closed, expired, assigned, or exercised. And the percentage net gain is based on margin requirement or actual cost, depends on what the trade was. Now we're going to give you some examples of what honest, accurate reporting is, and in this case what KissOptionPicks.com will use versus some other services. Take a moment to pause this table and maybe take a look at it, but I just want to point out a couple things. Is the difference in the prices here, and the difference in here in dollars, and again the difference in the percentages. As you can see, there is a large difference in the percentages, depends on how it's being recorded, so you want to make sure that this is honest and based on what we talked about before. Here is another one. Here we're showing you an example of trade results with or without commissions. So once again, you want to look at the overall difference between commissions and no commissions and the difference in dollars, and therefore the reporting percentage and 10%, and the difference is more than 100% difference between the results strictly because of the commissions cost, which you will incur regardless of what service you're going to use. Okay, compounded versus not compounded reporting. The conservative reporting is that we don't carry over previous gains to the next trade. What does that mean? Is that if you had a $5,000 account with, let's just say, this is an example, a 5% average return per trade, and you have 12 trades per trade, then on a non-compounded basis, you'll have a 60% gain for the year. And that's what KISS option picks use. If you had a compounded, then you will report 80% per year, and if you take 20%, the difference between 80 and 60, and divide by 60%, the difference is 1/3 to the inflated into the compounding gain, even though the dollar values are all the same. Okay, results are accurately updated and when suggests are closed, expired, assigned, or exercised. Percentage net gain is based on margin required or actual cost. And to get more information and example how this all works, go to this link that we show on this slide and open it up, and you can read the whole document. So to recap, apple versus oranges. You want an actual field trades. You want all the costs included in the results. You want it to be broker document, which of course, once again, if they were filled, they will be documented. And the trades are not hypothetical, and once again, if they were filled, they obviously have to be actual. And in closing, I hope this has been a very helpful video for you to watching. Thanks for watching, and until next time, hasta la vista. Stop.